Ladies and gentlemen, as the Dean of the Faculty of Business, Economics and Statistics, it's a great pleasure for me to welcome you all to today's discussion event on bank regulation and market discipline between two very eminent people, very knowledgeable people on this topic, who I will introduce in a minute. Let me start with Ewald Nowotny, the governor of the National Bank. Professor Nowotny is, of course, very well known in Austria and beyond, and therefore he does not need much of an introduction, at least to this audience. Let me nevertheless say a few words about him. I would think that he is the ideal person actually to participate in today's discussion because he has seen banking and bank regulation from all sides. As an academic, as a banker, as a regulator, and as a politician. He has been a professor of economics at the Universität for more than 20 years, has been in leading positions in various banks in Austria, such as the president of the Österreichische Postsparkasse PSK and the general director of the BAWAG, Bank für Arbeit und Wirtschaft. He has also served in the Austrian parliament for 20 years. And since 2008, he is, of course, as is well known in this audience, the governor of the Austrian National Bank, the OeNB. The other discussant, I think, has not been head of a national bank, has not been a politician.
No one would trust me with that.
As far as I know. But Charles Calomiris is a truly eminent scholar. And he is this year's OeNB visiting professor here at his faculty. So let me say a few words about his research, which really covers a vast ground in banking, corporate finance, financial history, monetary economics. His stature as an eminent economist and a broad profile really make him the ideal OeNB visiting professor to have, and it's a great honor for our faculty to have you.
My honor.
Thank you very much for being this term. So as a preparation for introducing him, I printed out his CV, and the printer went on and on and on. It's a very impressive CV, not only in terms of quality, but also in terms of quantity. It's actually 82 pages long. So let me just give you a short glimpse of what Professor Calomiris has achieved and what he stands for. So he has studied in Yale and Stanford, has been assistant professor at Northwestern University, and has been serving the Columbia Business School in New York City as full professor for the past 20 years. He currently holds many prestigious appointments, including at the National Bureau of Economic Research, NBER, and at the Hoover Institution. So Charles Calomiris is not the type of academic who, sits in his ivory tower and writes some obscure theories that nobody can understand. Instead, his research really skillfully combines theory and empirics and is often highly relevant for pressing policy issues in money, banking, and finance. He is therefore a much sought after advisor. He has served as a consultant for central banks in many countries, including Brazil, El Salvador, and Argentina. And he has, of course, one is tempted to say, of course, also consulted for the US Federal Reserve System in various functions, and has been a member of the Shadow Financial Regulatory Committee in the US. But he also knows Europe quite well. He has, for example, been a member of the Advisory Scientific Committee to the European Systemic Risk Board for 2 years, giving, I assume, good advice to Mr. Draghi. So, Professor Calomiris is an extremely well-published scholar, and he has published in leading journals like the Quarterly Journal of Economics, the American Economic Review. And just to illustrate how prolific he is, let me mention that he, in the past 1 year, so in one single year, he has published 3 papers in the Journal of Financial Economics, which is a top 3 journal in finance. That's an impressive record. So, but he's not only well published in journals, he's also an influential scholar in politics, policy circles. I think this is so because he has an ability to write crisply and clearly and he writes very readable books. So a well-known book is Fragile by Design, Political Origins of Banking Crisis and Scarce Credit, which has been translated to 5 languages and has won many awards, including from the Financial Times and Bloomberg Business Week. No wonder the weekly newspaper, The Economist, named Professor Calomiris as one of economics' most influential people, and that includes both living and dead economists, most influential economists. Yeah, that's something. Living and dead economists. Yeah. So you're still in the category of living now. Yeah, thankfully, but that's something. So I would like to thank the Austrian National Bank, especially Governor Nowotny, for enabling our faculty to bring eminent scholars like Charles Calomiris to our university as visiting professors, and I would like to thank both of you for being here today to discuss. We are very much looking forward to the discussion. The format, just to mention this briefly, is that we will witness a discussion among these 2 eminent scholars and very knowledgeable from both sides. We will have witness this discussion, and then at some point we will open the discussion for questions, and so that everyone can participate and ask questions. And then, as things normally go, time will be too short, and then we can continue our discussion over a drink and some finger food back there. So welcome to all of you. Thank you both for this discussion.
Thank you, Professor Tiran, for this very kind introduction. Welcome to all of you. This is part of the OeNB Visiting Professorship, and it shows the very high interest we have as Austrian Central Bank to have a close relationship with the academic community, because this is extremely important for us in our economic thinking, and also helping our collaborators. So on the occasion of the 200-year anniversary of the foundation of the Austrian Central Bank and the 650th anniversary of the foundation of the University of Vienna, this OeNB Anniversary Visiting Professorship was established, and I see here my friend Max Kotbauer, Vice President of the Austrian Central Bank, at this time also President of the Supervisory Council of the Vienna University, who was very active in creating this, and I'm very glad, Max, that you see that your work has borne fruits, and very excellent ones, as we can see here. And of course, this is not a one-off event, but every year we have the honor to invite colleagues in this way. Professor Calomiris has been already shown that about his very impressive career. I have to a bit explain why the 2 of us were late, because we had a very interesting talk in my office where we discovered that both of us, in one element of our life, were entrusted with saving a bank. So we have had some kind of practical experiences, which is also quite interesting to compare. Having heard about the experiences of Professor Calomiris, I have to say that Austrian supervisory policy is not as bad as you would think if you compare it to the American counterparts. So, as governor of the Austrian Central Bank, I'm also the deputy chairman of the Supervisory Council of the Austrian Financial Market Authority. So we combine these two fields. We, especially with regard to banking supervision, we usually get a lot of criticism. I have to say, for central bankers, this is the most dangerous part of their activity. Just today, you will have read that my Italian colleague is under heavy attack in the Italian Parliament. So banking supervision is a very delicate issue, but we are always told about the shining example of the US, and I think this talk we had was quite, I think, a bit eye-opening in that respect. So what I would propose to do is that perhaps first we may invite you to give a bit an overview of some of the perspectives that you have been dealing with here at your stay at the University of Vienna. You gave this summer a talk on reforming financial regulation after Dodd-Frank. I just came back from Washington from the IMF meeting this Tuesday, and one of the talks at Washington had been, of course, again, what's about Dodd-Frank. It is, of course, very much connected with the choice of persons at the Fed. So this is an ongoing issue. And perhaps if you could give us a first account of your views, and then we could go on with some further aspects. Please.
Thank you very much, Governor. And Dean, thank you also for the kind words. Excessive, but very kind. Thank you. And let me thank all of you for coming. I've had a great time in both of my trips this year to Vienna, and it's really been a wonderful and impressive visit for me. The faculty and the students have really made me very welcome, and I've had a lot of fun teaching the PhD students who are really first-rate students, so it's been a great pleasure. Interestingly, the lecture that I gave at the central bank in my last visit, which was all about what we should do differently in financial regulation, was a kind of inspiration for the PhD course that I gave, and I ended the PhD course with that same lecture, in case any of the PhD students hadn't heard it when I was here before. But the thing that's interesting is, because I'm a financial historian as well as a banking economist, is that I know that the world used to be extremely different from the way it is now. And in one important respect, which is that financial institutions, banks, were much more thinking about the markets than they were thinking about how they were going to be protected from the markets. If you go back, let's say, 130 years in the US, some research I've been doing about banks during that particular time frame, we didn't have a Federal Reserve. We didn't have any FDIC, and that meant that banks were really in some sort of raw relationship with their sources of funding. And coming from that kind of thinking, you really see how the market and banks tend to work together. And so a lot of the course that I did here was to try to show students really, it was really like a memoir of my entire research on banking going back to the 1980s, because I started working on the question, what was the world like back then when we had sort of pure and very strong market discipline and we didn't have so much protection of banks? And how has the world changed as market discipline has lessened? And the answer, I think it's pretty clear, is that we're now living through, in the last 30 years, the worst pandemic of banking crises that we've ever experienced. And if you look at the literature, which I reviewed in this past year for the annual review of financial economics, what is the role of deposit insurance and other protections that have evolved? What is their role in this pandemic? And the answer of the literature is they're the primary cause, which is an interesting thing, because this was a safety net that was created supposedly to stabilize banking systems. And yet, if you look at the literature says it's the primary cause of the instability through the way that it has undermined the effectiveness of incentives for banks to manage their risk properly. And then you say, well, but prudential regulation is all about trying to substitute for market discipline, a regulatory discipline that prevents banks from taking advantage of that safety net. But the problem is prudential regulation doesn't generally work very well. And so what I've been trying to do, bringing us now back to the theme of reforming financial regulation, is to think about, it seems like there are two paths that you might think you would go down. One would be to try to get rid of things like deposit insurance. That might be a sensible thing to do from an economic standpoint. It might be, however, very, very challenging politically. Another approach would be, is there a way to bring some of the information and discipline from market information into the regulatory process to improve the regulatory process so that you can get rid of some of these costs that come from banks' abuse of protection. And I think it's fair to say that that was really the theme of my first lecture, and then this course that I just gave was really about going through, of course, in academic, rigorous way, the theoretical foundations of all that I just said to you, as well as the empirical ones. So that's been the theme of my presence here all around, which is how can we bring market discipline in? I would claim that can simplify regulation, make it more effective, and make it less costly. And I'll close with one other comment. So the issue right now, if you look at the deregulation discussion in the US or change in regulation, I think has been miscast. If you look recently at the Treasury's report that just came out on depository institutions and regulatory reform, and a lot of the press discussion, and a lot of what bankers are saying, they're saying we need deregulation. We need to reduce the costs of regulation. Now, it is true that regulatory costs are very high, and the banking system clearly is suffering from those costs right now. However, I would say that we don't just need deregulation. We need improved regulation to make it more effective. And I think that that's a theme that needs to be emphasized more. That it's not, we've already lived through, the world has lived through, what happens when we don't have regulation in the presence of safety nets for banks. And the answer is abuse of safety nets and very major financial crises. I'll summarize that for you so that you can see why I feel so strongly about it. If you looked at the period 1874 to 1913, worldwide, how many things that we would call, using an IMF standard definition from a study by Levin and Valencia, banking crises happened? 10. What was the severity of those crises in terms of the negative net worth of failed banks as a fraction of GDP? On average, it was about 3%. Now, if you look at the last 40 years, a comparable time period, 40 years in length, how many banking crises have we had? 100. What's the average severity? About 16% of GDP, which is unbelievable. The Great Depression in the United States, by the way, was about 2.5% of GDP by severity. In other words, we're living through something that we've never seen in world history before. And it's not a coincidence that this is coinciding with a combination of expanded protection of banks and inadequate prudential supervision. So one thing I'm a little worried about in the US is the emphasis just on regulatory costs and deregulation. I admit this is a problem, but we can't just be thinking in that way. We have to also be thinking about the costs of having a regulatory system where we don't have adequate regulation. I'll stop there.
Thank you very much. If I may follow up with this aspect, and of course, following also your paper with this nice title of stealing deposits. My feeling, and I have to add that I had this situation that as CEO of a bank, I was eyewitness to a bank run. So where you see that pure hysteria is coming around. And of course, it's not only the bank run that you observe on the street. The more relevant bank run is the one that comes from the big investors, so that the big institutions that are taking out their deposits. In this specific case, the only way to stop this is to have an encompassing government guarantee. The only point is what is the right moment when you issue this guarantee. But the general point is why I think that it is perhaps a bit too narrow to look at this only in kind of moral hazard perspectives. Because the real point is, and this is in many cases of the literature perhaps not so fully shown, these are the external effects. Banking is, the whole banking system is an extremely fragile psychological network. Problems in one area may create problems in other areas. And so it is very important to stop this as soon as you can. Of course, the best thing is if you have efficient regulation that avoids this kind of thing. But this is human life. You cannot rule it out that something may happen. And if this happens, then I think a very fast, a very encompassing regulation makes sense. You may remember that in 2000, when there was the big economic crisis in 2008, then starting from Ireland, all countries more or less engaged in an all-encompassing deposit insurance, 100%. Which, of course, was not without problems, because in fact, it would have, if it would really have become relevant, it would have been amounts no country would have been able to pay. But it was all about psychology, and so it never was used. So also this guarantee that I got from the Austrian government for this bank I was heading, not €1 was needed. Because if you have it, it stops. But if you don't have it, then you never know how this is going to develop. Perhaps another point of underlining the big role of information. As you may know, we have now at the European level the concept of banking union. And the first pillar of banking union is common banking supervision, with a single supervisory mechanism, so this is going on. We have now, as the second pillar, bank resolution. This also started. And the third pillar is sort of a European system of deposit insurance. And this is not yet in place. And I think it will take quite a long time in place, because, again, it's a matter of information. There is a feeling that having one single fund, one single pan-European fund for this, that this fund might be used by some countries in a very systematically more intensive way than by others. Where you have the feeling that the banking system of some countries is in worse shape than others. You don't have the full information, and therefore the argument, and this is the argument from the Austrian side, from the German side, is as long as we do not have this adequate information, we are not prepared to enter this system of European banking insurance. Also, of course, if there would be a system, it's quite clear that it would have a stabilizing effect, because it would avoid that, let's say, countries from, or the depositors from, savers from one southern country move the deposits to northern countries. If it's always the same. But as long as we don't have this, so this is this transfer element that is coming in. So you see this also on the European side. If I may kind of try to use this occasion in a bit a different way. Again, with giving you some numbers about basic differences in the financial system of the US and of Europe. And my question then would be, are these, in your view, relevant differences with regard to banking regulation or not? And the most important is, of course, as we all know, that the European system of financing is a bank-based system, whereas the US system of financing is basically a market-based system. That means banks are much more important in Europe than they are in the US. Just to give you two numbers, The one is the stock market capitalization as percent of GDP. It is 147% in the US, it's 65% in the Euro area, in Austria it's only 31%. So this is the capital market side. On the other hand, the role of banks, size of the banking sector, again, as percent of GDP, is 294% in the Euro area and 85% in the US. So that means banks play a totally different role, or at least from these numbers, as compared to Europe. So would you imply that from this some kind of also different approaches in regulation would be appropriate in the US and in Europe?
It's a tough question, not one that I've thought a lot about from the perspective of the size of the banking system. So let me come to it while I'm thinking a little bit. So first, I would say sometimes that distinction of markets versus banks can be a little, I agree with it, but it can be a little misleading. For example, one of the highest credit to GDP ratios in the EU is actually in the UK. And the UK, of course, is a highly securities-oriented financial system.
Yeah.
So it's an example where you see
I have the euro, because you really have to see, UK is kind of the Atlantic part of it. Euro, so
okay.
it's
but I'm saying that if you look at the UK, you'll see that it's one of the highest in bank credit relative to GDP, but it's also very high in securities markets. And so the reason for that is that a lot of things are happening in the UK that are international. So that's it, where it's really, you're right, that the UK number is a little bit misleading from that perspective. But clearly, what I think that does mean from your perspective is that you're more powerful as a central banker. So in the US, of course, the Fed still has a lot of tools and it operates through a lot of different vehicles. But in Europe, that means that bank lending is really just a much bigger phenomenon to be able to control. And the fact that so much of the financial system is not in the shadows means that you have more direct control. So I think there's a positive from the standpoint of financial markets, of financial intermediaries in Europe being able to be controlled in the sort of less size of a shadow financial system. So I think that's part of the advantage right now in thinking about the use of monetary policy or other tools that can operate on the banking system. Maybe a disadvantage is a little bit less dynamic, especially if the partnership between the state and the banks, between the governments and the banks, becomes something that's not progressive. And I think we'd have to say that in some countries in Europe right now, that's a big problem. What we saw in this crisis, of course, is that Europe's banking system also became more regionally isolated during this crisis. So that, for example, banks in particular countries have been lending more within their own countries, holding more of their own sovereign debt. And I think part of what we're seeing there, frankly, is a political outcome of in some of the academic studies. I'm going to put it less politely than the academic studies do. The governments will pretend that the banking system is solvent if the banks will pretend that the government is solvent. The banks will buy the sovereign debt of questionable sovereigns. This was, of course, especially important in Southern Europe. If the governments won't be too tough in supervising the banks. And then that is a big part of explaining how the sort of balkanization of the financial system has progressed. So on the one hand, I think you could say that it affects the power of the central bank, but then on the other hand, the national governments are still very much in control of the political equilibrium within their countries, which has been a source for, let's say, backwardness. And so there are many things that come out of your question. Those are the first couple of things that leap to mind about some of the challenges, but also opportunities from having that kind of financial system.
May I ask you for one specific aspect? Because having this much greater role of, let's say, the market financing in the US, couldn't this imply that a strategy of asset buying, of QE, that works via the market is more effective in the US than to be expected in Europe?
It's an interesting point. And of course, but if you look at the QE, what is the QE in the United States? It's been Treasury securities. So in that sense, it's quite similar to, I think, the situation here. Also, of course, AAA mortgage-backed securities have been purchased. Now, the studies of QE's effectiveness in the US have generally found, so we have to do a little bit of dividing. So QE1, of course, was a truly emergency intervention. And I think we can say that QE1 had major positive effects in stabilizing the markets. But that was very early on. That was almost a decade ago that we're talking about QE1. QE2 and QE3 are much more controversial. I would say there's no real strong evidence that they have had a positive effect. However, there is some suggestive evidence of a positive effect. But that evidence, when you look at which aspects of the purchases have mattered, I would say that at least it's controversial, but my view is that the parts that bought the mortgage-backed securities had more effects on the economy than the purchases of the Treasury securities. And then, so that's related to your question. Why is that? Well, because the purchase of the mortgage-backed securities were really affecting a credit spread. They were affecting the difference between mortgage interest rates and the government bond rates. They were really a fiscal policy, not a monetary policy. They were really subsidizing mortgage finance directly by purchasing mortgage-backed securities. Now, that could be done by purchasing, I guess, mortgage-related bonds produced by European banks. You could, you could also have that same tranching where you're producing the upper tier of those bonds. So I'm maybe getting into an area that I'm not as much of an expert on the European side. But I think that in that sense, I'm not sure that the opportunities for QE, at least as it's currently being done, are so different than in Europe, because you could still have the same kinds of instruments. Now, if you were going to do something like what Hong Kong did in 1997 and 98, where they actually bought equities, the central bank bought equities, that could be a very different kind of mechanism. But I don't, now with the changes in Dodd-Frank in the Fed's powers, the Fed is not really going to be doing too many aggressive things, I think. I think that the answer is that you could definitely imagine if a central bank, let's take Hong Kong. So Hong Kong is also, very much a securities-oriented sort of financial system. And when they were under attack in their currency, they used purchases in the equity market as a way to offset the attack. And I think that could be, you could think about using securities purchases very broadly. But so far, I think that the U.S. has been fairly limited in the kinds of things that they're doing. And really, it's even the mortgage-backed securities, it's just the AAA tranches and the GSE-related AAA tranches. So it's very limited. They might be able to go farther. But in agreement with your point, most of the evidence that QE2 and QE3 have had any effect at all had to do with the fact that they weren't targeted, the parts that weren't targeted to the treasuries, the parts that were targeted to the mortgage-backed securities.
Well, if I may refer to a much more simpler point, because the whole effect or major effect had been to lower interest rates on capital markets. That has led to a huge increase in valuation of stocks and others. And the idea is that this, via a wealth effect, had been an expansionary effect. Do you see this wealth effect as something relevant in the US? I think it is not really relevant in Europe because stocks just play a much smaller role. But does it have an effect in the US?
I think there's no question that it has. But I wouldn't say that's a QE story. That's an interest rate policy story.
But it's indirectly via QE lowering the interest rates on the markets.
Well, we can argue about that a little. I mean, I don't think QE is part of that story. I think it's the interest rate policy. QE can be part of it, but if you lower the interest rates and you provide forward guidance that basically says you're going to keep them low for a long time, now the discount rates that are relevant for the stock market or for the commercial real estate market or the farmland market are all creating huge appreciation. In fact, I would say that farmland in the U.S., just to give you an asset class that we don't usually talk about, is probably conservatively more than 30% overvalued right now. I think the stock market's overvalued. I actually think the central bank is, in the U.S., has, through this protracted period of low interest rate policy, has fueled asset price increases that may not be sustainable. So, and the easiest one to look at is farmland. Because you see, with equity, you can make lots of projections about future growth of the firms. But if you look at a piece of farmland, you know what the yield per acre is. Okay, you know what the yield per acre is. And so then you can say, does the yield per acre look like it can possibly be worth all this going forward? So I think that we are seeing asset price bubbles. Is that wealth creation? Well, for now, maybe. But that may be wealth destruction tomorrow.
Yeah. If I may follow, because also you have written extensively about this, the aspect of real estate, the connection real estate monetary policy. I found it rather interesting that you see this lending bubble in subprime lending as a politically motivated activity to help the poorer element of the population. Hasn't this to be seen also in the context that this was started in a time when there was a general belief in market solutions? So you wanted to get away from public sector solutions. The European answer for helping poor people to get housing is to have social housing. Mm-hmm. And wasn't this a policy to substitute social housing? That means to substitute government intervention via banking policy, and I think it horribly went wrong.
It's a good point. I would look at it a little differently. So Raghu Rajan's book, Fractured Finance, and my book, Fragile by Design, talk about this exact question that you're asking. Why was it the U.S. subsidizing risky housing to help the poor? And I want to first talk about, did it work? It did not work. Okay, why didn't it work? If you get to a position where you tell people, you don't have to show that you have income, you don't have to show that you have a job, and you don't have to have any money down to get a house, it may sound very good, but then very soon they're going to lose that house because they don't have income, they don't have a job, and they don't have, and when the price of the house falls, they've lost the house. So it turned out that it was a disaster for the poor. It was a very bad policy. I think that the answer, what we really are grappling with is, it's much more difficult in the US. We don't have a parliamentary system. We have divided government. We have two houses. Britain has two houses of government, but the upper house of government no longer has any say on economic policy matters since 1911. We still have a Senate and a Congress. We have federalism, lots of powers still divided between the national and the state governments. And we have an executive branch and a legislative branch, separate from, so it's a very difficult. So the answer that I think you get from Raghu Rajan in my book too is it's hard to do some things in the US. The kinds of policies that might make sense to deal with inequality are actually very difficult to do. And so it turns out that you can find, let's say, coalitions to behind the scenes do invisible agreements for things they couldn't do on the budget. So the reason they use credit, subsidies, invisible credit subsidies, is they're not on the budget. They're not something that's a transparent agreement. They're something that's a hidden agreement with hidden costs and not necessarily a very effective deal. So I think that the way I would say it is we actually are seeing the limitations of our government to actually be able to achieve things, and then we're doing things through the back door in a very counterproductive way. But that's really where we are. So my view is that we have to have a new kind of grand bargain in the US that's going to try to not use financial subsidies to achieve things that are better achieved with other policies. And I think that it's a government structure problem and also a division right now. We have a very divided population. So it's very difficult. The combination of our government structure and our divisions right now in our country make it very difficult for us to accomplish things that are very sensible. So, and I want to point out, in case you're wondering, I'm a Republican. So I'm not talking about, I'm not coming at this from a leftist perspective, but nonetheless, I think that there are some obvious good policies toward the poor in the United States that haven't been pursued. And the problem is that it's very hard to get agreement in our government to do it.
Not to force more on distributional aspects on you as a Republican, but perhaps to do it on the other way around. Because we do have a big discussion also now just this weekend in Washington, Davos at the IMF about distributional effects of monetary policy. And could you give us some of your idea? First, in what way do you see it? Second, does it matter? And what would become some kind of alternatives?
Well, when you say those words, what I hear from the US perspective is, who's been made rich from the protracted loose monetary policy is the rich. And of course, wages are just now starting to catch up, though, in the US. So it's starting to look like we're going to see a recovery and an expansion of real wages, and median incomes now look like maybe they're rising. It's controversial, but it looks like they're rising. So we're starting to see something there. But it's a big problem. I think it's a problem for monetary policy because it has actually accentuated this. And the bigger problem, from that, I just got a very nice essay from my friend Bill Poole, who used to be in the Federal Reserve System, looking at inequality issues in the US. Even if you're not particularly worried about long-term inequality positions in the US, you could still be worried about the Federal Reserve's credibility in the population. If the monetary authority is perceived as accentuating inequality problems, it undermines their credibility. I think the Fed is in a very weak position right now. I think that some of it is not their fault, some of it is their fault, and they are right now, this is not a helpful thing for them. One of the arguments you might make for why the Fed needs to restore a more normal monetary system is that I think this is actually part of the problem. If you're a fixed income earner, zero interest rates is not very helpful to you. If you're a wealthy billionaire, the low interest rates have caused your properties to skyrocket. People are noticing this. This is not just economists who've noticed this. So, and it does affect the Fed. There are some people attacking the Fed right now for reasons that are a little crazy, but there's some people like me attacking the Fed for other reasons. The Fed is within the group, I would say, that are seeing the Fed as through the lens of this wealth creation for the rich, it's creating more of the first kind of thing, the populist attack on the Fed as an institution. Some people in the US are even talking about ending the Fed, as you may know. Now, I'm not saying that's going to happen. I don't think it should happen. It's not likely to happen. But it's one of the unintended consequences of this protracted period and the creation, in my mind, of these kinds of financial bubbles.
But so what you describe is exactly what is going on in the US. On the other hand, of course, there was a need for the Fed to act in this very big crisis. So does one have to accept this is kind of, you can't have the one without the other?
Yes.
Or would you see some kind of how to combine it a bit?
I just think they waited too long. I don't think QE2 and QE3 were worth what they did. And I don't think the protracted low interest rates were worth the consequences. So my own view is, yes, you could look at where we are right now and say, we're still below our 2% target, unemployment is doing great, and the Fed has been a wonderful success. I think that the Fed would have been just as much a wonderful success if about a year and a half ago they had started gradually raising interest rates. Monetary policy would still be accommodative, but we should have gotten behind the curve earlier. I'm not saying that would have been a solution to everything, but I don't believe that QE2 and QE3 have done much for us, and I don't believe that the protracted zero interest rate environment was helpful. We didn't need it, and I think we could have solved some of these perception problems. Also, you know, we were talking earlier about this. I have a lot of evidence that you would have, if interest rates had been going up earlier, you would have had a slight negative for the mortgage market, but you would have had more positive growth of bank lending. Because rising interest rates, actually when interest rates are at zero, really do help to propel bank lending. And I think that could have been more helpful. What's been missing in our recovery in the US is small and medium-sized enterprise growth. Missing. And what's been missing that's been explaining that, I think, is very low lending by banks. And the problem is the banks, it's not just the regulations, that's been a contributor, but the monetary policy has actually been negative for bank lending. So it's been very good for the dollar, making the dollar weaker than it would otherwise be. It's been very good for the mortgage market, but it hasn't been very good for small businesses.
May I imply from what you said that central banks should start increasing interest rates even way before they reach this kind of 2% goal?
Well, the point is, you know, as we were talking about it earlier, if you're below your inflation target, even on a medium-term projection, as you are in Europe and in the US too, right? So we're still looking 2 years or 3 years ahead, we're still looking, projecting that we're just getting up to 2%, right? So that means it makes sense for monetary policy to remain accommodative, meaning more than your interest rate level in real terms should be below whatever you think the natural rate is. But that doesn't mean it has to be zero, right? Accommodative means that the interest rate is below the long run rate, but it doesn't mean that it's zero. So I think and the other thing that people have forgotten is, especially when you're starting at a zero interest rate, because that's helpful to banks when you raise interest rates, the monetary policy transmission mechanism has a mix of influences. Some of them are positive and some of them are negative. So it's not like if you were starting at a higher interest rate during normal kinds of periods, you would only have negative influences from increasing interest rates. But where we are right now, you actually have a mix of some positive influences along with the negative. So I think that the cost to us of raising interest rates from the zero floor are not as great as they used to be under normal circumstances. And I think that we have to start thinking a little bit about the risks of these big central bank balance sheets. Because, you know, when inflation hits, it doesn't always conform to central bank forecasts. Inflation can rise very quickly. If you look back, for example, in the US, 1939, bank lending in 1939 and 1933, the levels were almost identical. But within just a couple of years, banks had decided, and I could talk about why, but it's not that relevant, decided to increase their lending by 20%. I think we're in that kind of position right now. That if we saw interest rates rising and we saw a little bit of optimism starting to happen, we could see a very large increase, rapid increase in bank lending, and then the central bank would have to put itself into the position of thinking about inflation very quickly. So I want to get the central bank back to a position where interest rates, we have a little bit of room to cut interest rates or to increase interest rates. I think we're boxed in a little bit with these inflated central bank balance sheets. I'm very worried, and I'd like to get us back to more of a normal situation.
It would be very interesting for me to go on, but I get strong signals that we should now open discussion.
Sorry, my answers are too long.
No, but if I only, because we have here, of course, eminent economists and students among us, if I may just make one observation. I think what you just have seen also from the arguments of Professor Calomiris is a strong reference to analysis of economic history. And I think, now speaking in my former capacity as an economist, I think this is a very important research strategy. Just in the US, I think one really can observe that this approach of, let's say, analytical, historical view is something that many of the most interesting papers, including many of yours, are just based on this. So just to finish from my side with this kind of analytical remark. Now we have the chance to open discussion. Please, I think a micro is somewhere. Here it is, and you are invited to put questions.
And just ask the governor, you seem to agree with Professor Calomiris about the analysis of the US, and you emphasized, well, this is the US. Now, is Europe Europe following the US, doing a mistake, if I may interpret it this way, is doing monetary policy for the rich, or how could, well, either policy be changed, or to what extent is actually Europe different?
Well, you see, first I think, but now you give me a chance to to have a second round with this discussion. First, of course, I think one has to see it in a broader context. Yes, of course, if we have via lower interest rates or rising asset prices, basically this is because wealth is much more concentrated than income, so it has, let's say, a negative distributional effect. But of course, the first part of it is, of course, you do all this not to help the rich, but to avoid a crisis. And that means to avoid high unemployment. And of course, unemployment, nothing is as damaging with regard to distribution as high unemployment. So I think one has to see this in the context. As far as you manage to avoid high unemployment, but of course we know monetary policy is only one element. It cannot do the job alone. So, but that is, I think, a basis which I would accept for having this. On the other hand, again, as you, this is why I have mentioned these differences between the US and Europe. Of course, private wealth distribution is much more unequal in the US as compared to Europe. It's going to change a bit, but not yet fully. So therefore, this, I think, is a more pressing problem, but it is, of course, a problem, yes. I don't know if you...
No, I can't help you. I think you did a very good job dealing with a difficult question. I think the question right now, to be more constructive, is what should Europe be doing going forward? And I think the answer is that it's time to start raising interest rates. So I'll just leave it. That's my opinion.
As you may know, we have a policy session of the Governing Council next week. We have what is called in our jargon the Purda period. That means Purda, this is the burqa, so this comes from the English colonial language, so I have to veiled. I must say nothing on this.
But I can talk.
Yes, you.
So I want to emphasize part of the advantage of having a bank-based economy is the likely consequence of a rise in interest rates. It will have negative effects on mortgage markets. It will make the currency stronger, but it will also make bank lending expand. So I think you could even argue it would be a close to neutral effect on the economy now that you're recovering to start increasing them. So I hope that they will start thinking about that.
But perhaps if I may add one thing, because also to put a question in disguise, of course you know with regard to interest rate policy, the ECB is enshrined in what we call forward guidance, saying that we will have increases in interest rates only after the end, and it says even long after the end of our asset buying program. I'm not so sure. Does the Fed have something similar? Is there some kind of forward guidance in this way?
Yes, they've been using forward guidance too. And you know, there was this theoretical article that Mike Woodford wrote about the usefulness of forward guidance, which was very influential in the U.S. And I even there's a paper from the Chicago Federal Reserve Bank president, Charles Evans, and some of his researchers that was presented at Brookings, even arguing that forward guidance was something the Fed has been doing one way or another for many years. I was the discussant of that paper, so was Mike Woodford. I think we were both pretty critical of that claim, but there's no question that they've been doing it for the last several years. And to some extent, you know, forward guidance is not necessary for making expectations of interest rates stay very low if people understand the reaction function of the central bank. If your reaction function is clear, then you don't have to talk too much. So I think part of what we need to worry about in the US is less talk and more of a systematic framework that we've made clear. That doesn't mean necessarily a Taylor rule, but it means instead of having people say, well, you know, we claim this or we claim that, have some sort of a framework that everyone understands so that they can see why interest rates are likely to remain low. You know, if a central bank, I'll ask you a general academic question, if a central banker says he's going to keep interest rates low for 3 years, but then a year and a half from now, the economy changes and it looks like it would be a good thing to raise interest rates, should the central banker raise the interest rates or keep them low just because he said that he was going to? So you put yourself into a difficult position.
Yes. Because then you get into this credibility.
Exactly. But if you have a framework that's transparent, then you don't have to get into those difficulties.
Mm-hmm. We have some more questions.
Yeah. Sorry.
We could talk for a while.
I regret a bit that the discussion very quickly strayed from the declared topic of the evening, from bank regulation to interest rate policy. I'd like to try to get it back to the stated purpose. I was working in London for US banks for almost 15 years, London, New York, and Chicago. And that was the era of the Glass-Steagall Act, which was introduced after the Great Depression in the 30s. That seemed to work very well. Banks were either commercial banks or they were investment banks, and they were allowed to do certain things and not others. And that, to my mind, was a strategic type of legislation. Then, I think in Clinton's second period, that was done away with. And all the banks could do whatever they wanted. And it didn't take too long before the crisis erupted. Then, in the attempts to reintroduce sensible regulation, along came Paul Volcker and the Frank-Dodd Act. I haven't followed it in detail, but apparently those are huge tomes of legislation. Whereas I imagine, I never saw Glass-Steagall in print, but I imagine that to have been a fairly thin booklet. And the regulations are now so detailed and so voluminous that the banks hit by them are the smallest banks who never did anything wrong, never caused any evil, but they simply cannot afford to comply with all these rules. And they close because it's not economical for them anymore. And I think that's a big mistake to have complicated things so dramatically.
Right. Well, there are many pieces to your question. And I'm trying to decide which thing to pick from that. Let me start with the financial history piece of it. So the Glass-Steagall Act was mainly, its main effect when it was passed, and I'm now referring to the separation of investment banking and commercial banking as it was passed in the 1930s, was really to take commercial banks out of the underwriting business, not the ownership of equity business. They were never in that business. The underwriting of bonds and the underwriting of equity. What we changed in the 1990s primarily was to do with allowing commercial banks back into, through the special affiliates, Regulation Y affiliates, to let them back into underwriting. There was no connection between underwriting and the financial crisis. So just to sort of dispel this, allowing commercial banks to get into underwriting, which was the main thing that happened in the 1990s, had absolutely no connection to the crisis. So the notion that somehow the repeal of Glass-Steagall was related to the crisis, I think, isn't right. Looking at it from the investment bank side, notice that the standalone investment banks, like Lehman and Bear Stearns and Merrill Lynch, had no trouble getting into a crisis even though they weren't commercial banks. So it wasn't the mixing of commercial banks, either coming from the investment banks side or from the commercial banks, that was causing the crisis. The crisis was caused by the subsidization of mortgage risk, which both of those kinds of intermediaries, whether Citibank or Bear Stearns and Lehman and Merrill Lynch, were involved in heavily. So I think the question of understanding the crisis is more about that. Now, Paul Volcker, when he proposed the Volcker Rule, which the Volcker Rule now comes at this a different way. And my preference would be for the Likainen version of this, the European Volcker Rule, you could call it. But Paul Volcker's rule was that banks were not to take any trades on their own book as part of their own speculation. And also were not supposed to be running funds that did that anymore. And the problem, of course, is that no one could figure out what that meant. Paul Volcker couldn't. He kept complaining that it was so complicated. But the reason it was so complicated was it was incoherent. That's why it was complicated. Why was it incoherent? All of these banks are the dealers in the securities markets. So first understand, they are the dealers. There can't be an over-the-counter bond market without these banks as the dealers. They maintain inventories in those markets. Now, Paul Volcker, of course, understood that. And so what he said was, well, we want the banks to continue being dealers. That means they have to own securities, right? Oh, yes, we want them to do that. Yes. Well, trading means you have to be owning them. You can't trade them if you're not owning them. So the banks are owning these inventories, and Paul Volcker had no objection to that. He said, but whenever they trade, it must be that they're acting as a market maker. Okay, how can you tell whether they're acting as a market maker? Now, that's why the Volcker Rule had to be so complicated, because there is no way to tell. So what you then have to do is, you have to hire a bazillion lawyers to keep a paper trail this big to try to prove that the context of the bank's involvement in the securities markets was in response to a customer's need, rather than the bank's own initiative. That's what the Volcker Rule did for us. Now, what would have been so much smarter would have been to say, we want to limit the total value of securities inventories that banks hold relative to capital, if you thought that was important. Notice that had nothing to do with the crisis, as Paul Volcker himself admitted. Why did the Volcker Rule get created? Even Volcker in his testimony admitted this had nothing to do with the crisis. What did it have to do with? Paul Volcker's own personal philosophy going back 30 years. He's been trying to advocate the Volcker Rule for 30 years. It has nothing to do with the crisis. And what this teaches us, too, is that crises and regulatory responses provide opportunities for people to do whatever their hobby horse is. And very unwise ones, like the Volcker Rule. Now we're in a situation where inventories in over-the-counter markets for debt are very low. By the way, the Volcker Rule probably isn't the primary source of that problem. But we're now in a situation where if we have a major shock in the over-the-counter debt markets, we could have a major systemic event related to it because the inventories are so thin. That means a lot of movement of prices in a particular class of securities. But it's not just the Volcker Rule, it's also the liquidity regulations and the leverage requirement, because those aren't risk-based. So these securities are actually very low risk, but you have to hold a lot of capital and a lot of cash against them because of the liquidity rules and the leverage rule. What that's done is disincentivize banks from wanting to hold inventories of these debts. And I'm studying this right now in some detail, and I'm quite concerned about it. And I've made a proposal that for purposes of, just for purposes of the inventories of debts in the over-the-counter markets, that we don't apply the leverage requirement, that we actually only apply a risk-weighted capital requirement. Because you see, the problem is these are actually very low-risk securities, but the banks are having to maintain very high capital against them, which has created a social bad, which is our society, the planet, doesn't have much dealer inventory in a lot of bond markets. Now, bid-ask spreads have been very thin, volatility has been very low in these markets recently, but that's going to change. And now we're going to then experience, I think, a regret about the Volcker Rule and also about the application of non-risk-based capital requirements to securities inventories.
I have to say, we have two more questions.
Sorry, you can't answer that question shortly.
No, I just wanted to ask, how would you propose to better coordinate the policy of the National Bank, I mean of the Österreichische Nationalbank, with the details in the market or with the detailed work in subsidies, for instance? Because my impression is in a market like ours, which is very bank loan dominated, it is also a market which is very equity demanding. So you have a lot of experts who are involved when a company is a little bit subsidized. So they could also judge whether this company will be successful even if it doesn't have equity because of the other assets like the intelligent products or the people who are working in there and so on. So they do all this work to judge whether this will work, and then it does not happen because some equity is missing. And that means that it's not possible to use that company and a lot of other companies for distributing these big amounts of money which are flooding the market because there is no policy to make work in detail easier, simply the distribution of that money.
I'm sorry, I'm not following the distribution of the money. I'm not understanding.
I mean, if you flood the market with money, with easy money, you also have to take care that you have creditors who take the money. So you must make it easier that people get loans, and you must also train the experts who judge
Yes.
whether this company is able
Yes,
to
yes.
work with these
Now I'm
subsidies
following
or
you.
not. Yeah? And you have to ease this policy there. So it's not enough just to make lower interest rates. You also have to go into these details. And nobody really cares for that when lowering the interest rates, I think. That's my impression, because
So,
it's
a big topic. I agree with you that you can't just, so let me say it a different way if I'm understanding you. If you lower interest rates, but you maintain regulations, let's say, or other practices that make it hard for banks to expand lending, then interest rates may not have their normal feature. So what we learned in all of our textbooks from way long ago was the deposit creation, right? So the central bank creates reserves, the reserves create deposits, the deposits are associated with loan expansion. But if there's a very costly capital requirement on the bank may decide to just hold the reserves, not to expand deposits, not to expand loans. And in fact, that's what we've seen. In the US in particular, banks are maintaining the largest balances of excess reserves that they've ever had. That's part of the reason that monetary policy is not very powerful. So that if the regulatory policies had been different, we would have seen, I think, clearly a major expansion of loans. How do we know that? Well, we've seen something in the US we've never seen before. I'm curious, the governor can say whether you've seen it here in Europe. I've never heard of such a thing in the US. Banks are refusing deposits. Large banks have been refusing deposits. They don't want them. Why? Because the regulatory cost of having deposits is too high. So you know that regulation has been a binding constraint on the expansion of bank activity when banks are refusing deposits. So it shows your point from a different perspective. But I don't know, has that been happening in Europe too?
Not in a direct way, but what banks are doing, if there are very big deposits, then they apply negative interest rate, just to have with the same effect.
Yeah.
I think a good example is, for instance, France. France is not going so well at the moment. So the idea is to flood the market with money. And then comes the wife of the French president and says, I had a small company, and it always was a problem with these employees who get so much paid when they have to leave. So the president says, I'm going to make ordonnance présidentielle to make it easier to get rid of employees and workers and to make it cheaper. You know? The problem is, this is a very microeconomic thinking, because everything becomes less previsible for the employees and for the banks if the employees cannot be sure to have, for instance, 6 months or 8 or a year after having lost their work to pay their credit. So on the one hand, one tries to flood the market with money. On the other hand, one cannot get rid of that money because the banks are not ready to give credit to people who cannot be sure to pay it back. Yeah?
I mean, it's a very challenging problem, and I know we're running low on time, so I don't want to go into it more, except to say, you know, it's hard because I don't want you to get the wrong impression. I believe that capital requirements in Europe need to be higher, not lower. Capital requirements in the US need to be higher, not lower. As I was saying at the very beginning, I don't believe that the answer to our problems in the banking sector is just to try to boost lending without thinking about risk. But that means that when you're recovering from a banking crisis where part of the cure is that you have to increase capital. And by the way, Thomas has a wonderful paper showing some of the risks right now in the European system from undercapitalization. So the problem is when you're coming out of a situation of undercapitalization, you need to both recapitalize your banks, which will inherently slow down the ability for lending to increase. You need to do that, but it means that recovery has to be slower. So I think we have to also not expect too much from the central bank, okay? The central bank cannot do, monetary policy is not going to cure all the problems in the economy It can't. We have to fix the banking system. That's going to be a drag on the pace of the recovery. And I think that the central banks would have done better if they had been more advertising to people the limits of monetary policy and the needs to be patient and to improve the safety of the banking system. So I'll leave it at that.
I'm sorry, this is our last question.
Oh.
And afterwards the...
Well, this is a very short question, and I think you may have touched upon the answer a few times tonight. And my question is just, if you had to just name 2 indicators that are actually useful for banking supervisors to focus on, what would they be in the prudential regulation of banks?
Oh,
and the second question is,
Love that
do these
question.
indicators actually differ across an economic cycle? As in, do they begin to change during the economic cycle?
And I'll answer your second question first. One of them does, and one of them may be. So yes, they will be affected by the cycle. So let me first say what they are. Instead of the book value of equity divided by assets or risk-weighted assets, I think we should use the market value of equity on a moving average basis divided by the market value of assets. And that's something you can measure every day. So in my discussion of this topic in the lecture, I talked about how if you were looking at predicting problems in the banking sector, if you had been tracking, for example, for Citibank, its market value of equity relative to the sum of the market value of equity and the face value of debt, which we'll call the market value of assets. If you had been tracking that ratio, you would have seen that it fell from 13% in April 2006 fairly steadily to below 2%. And like the other banks that had problems, the failure of Lehman was not some simple contagion. The problem was that it was a match in a tinderbox of counterparty risk. The counterparty risk was visible if you were tracking the market value of equity relative to the market value of assets. So Citibank was insolvent, in my view, in the fall of 2008. But its Basel capital ratio is 12%. So what I like to say is Basel III wants to make every bank in the world just as safe and sound as Citibank was in December 2008, which is not meant to be a compliment. Now, so the first thing is focus on market values. And I have some ideas of how to use that market value. The second thing we can do is let's talk about risk weights of assets. We know that we can create a risk weight for loans and even for bonds that's extremely predictive of loss. What is it? The all-in spread that bankers charge on the loan. So if you look, there are several studies, one by Bain and several authors, another by Santos. What do these studies show? They show that you can predict the underestimate of the risk weight on assets. So, we risk weight assets and then we look at their non-performing loan ratios and we find, surprise, surprise, bankers always underestimate the risks of their loans. But we can predict those underestimates. What's the variable that predicts non-performing loans and predicts the mistakes in the risk weights? It's the interest rate the bankers charge on the loans in the first place. Why? Because they want to be compensated for risk. So why don't we use that piece of information to actually construct our risk weights? I know why. Because it might work. It might actually work. And so do I think that the Basel Committee is a conspiracy for inaction and a disgrace? Yes. Thank you so much. I really appreciate it.